This is CGTN, China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Uche Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, emerging market stocks jumped today as mixed Chinese growth data raised expectations of more liquidity measures in the country. Chinese stocks, which make up a bulk of the emerging market index, surged more than 1% today. As a result, we saw MSCI's index of emerging market stocks rising about 0.9%. That's its highest level in 9 days. Meanwhile, South African stocks retreated today as investors assessed whether authorities are succeeding in calming the recent rioting and looting. While a steadier rand helped a recovery in locally focused sectors, we did see declines in market heavyweight Richmond and, of course, drops in mining majors BHP Group and Anglo American. Now, also coming up on the show today, Egypt's external debt jumps 21% in the third quarter of 2020-2021 fiscal year. Economic activity for East African nations expected to pick up in 2021 with a 3% growth. And China's economy shows signs of an unbalanced recovery. Well, our starting point tonight is in South Africa, where the country's largest food producer has temporarily closed all operations in KwaZulu-Natal and, of course, other areas affected by widespread looting and vandalism. Now, Tiger Brands estimates that it has lost over $10 million worth of stock, mostly as a result of that unrest. The company says it is assessing the extent of the damage to its property and infrastructure. It also says the loss of profit due to business interruption is still being quantified. Now, Tiger Brands has made claims with its insurers. Protests, of course, in South Africa began last week after former President Jacob Zuma handed himself into police to serve a 15-month sentence for contempt of a court. Well, let's get the latest from the ground. We're joined now by Sumitra Naidu in Johannesburg. As always, Sumitra, good to see you. Now, of course, Tiger Brands is South Africa's largest food producer. It says it's closing its operations in KwaZulu-Natal after most of its stock losses, worth over $10 million, came from that region. Paint us a picture as to the extent the recent events have impacted its bottom line and impacted other companies such as Tiger Brands.
Hi, Uche. Yeah, it's actually devastating how badly this looting and destruction has affected not only companies, but the actual food supply. So Tiger Brands is the largest grocery line manufacturer in the country. It's also one of the largest bread suppliers in South Africa. It hasn't closed down permanently, as you said, but it has had to halt its operations temporarily. We don't know how long that will be. The company couldn't give me an answer as to when it will reopen operations. Tiger Brands has lost stock worth around $10 million, but it has yet to calculate the costs of the damages incurred and rebuilding. So this figure could very easily double as they do that. And of course, as the company remains closed in the KwaZulu-Natal province, shares in Tiger Brands dropped almost 1.5% on the JSE today. Shoprite, another supermarket chain which owns the Checkers stores, was also hit badly in that province. They closed down stores and warehouses there. But the company said this afternoon that they are starting to restock and reopen stores in areas that have calmed down and are safer. The Clicks Group, which specializes in toiletries and medicines, has over 100 stores in KZN. Over 50 were badly damaged and looted. Clicks has since closed all of its stores in that province and some stores in Gauteng. It's estimated that retailers have lost close to $500 million in stock alone. So, for many of these companies, they were just emerging from the impact of last year's hard lockdown restrictions. Some are still struggling to get above water. Uche?
Well, as you mentioned, Tiger Brands is the largest food producer in the country. You also mentioned all those store closures going on. So how is this move impacting food supply in the KwaZulu-Natal region?
Well, people can't access stores because many of them have been damaged and closed. Wherever stores are open, there's little or no bread and other daily basics because the delivery trucks are not moving in that province. Some of the major routes in KwaZulu-Natal are closed and most companies are still assessing the security risks because the trucks were being targeted and burned when the rioting and looting started just a few days ago. One of the largest oil refineries also shut down operations this week, causing fuel shortages. So it's no longer as easy as getting in the car and driving around looking for groceries. There's long queues of people waiting at fuel stations trying to fill up. There's also been panic buying, more especially in Gauteng. People wiping out the shelves, worried that the trucks won't be able to deliver. But the situation in KwaZulu-Natal is dire. Unemployment is very high there. Poverty is also rife. And people there were struggling amidst the COVID pandemic. This has just worsened the situation. And there's now the threat of people dying of hunger. There are several efforts, relief efforts underway to assist. ShopRite has pledged 1 million rand towards relief efforts and food vouchers for those affected. But the highway between KZN and Gauteng has been closed. They are working on reopening that main transport route to get the trucks back here. But of course, with very few trucks that are still around and the security risk still being assessed, that route may take some time to be reopened.
Well, as always, many thanks for that update. Sumitra will certainly continue to watch the situation on ground. Of course, Sumitra Naidu joining us there in Johannesburg. And moving on now, the industrial property sector in South Africa is showing signs of a recovery, suggesting that the economy is on the mend. However, the latest rioting and looting in some provinces in the country may delay a full recovery. Sumitra Naidu has more on this.
Warehousing has grown in South Africa as more businesses stock up to cater for the consumer. With the manufacturing in recovery mode, the demand for large industrial factory space has increased too. According to the latest F&B property broker survey, only the industrial sector has managed to recover to pre-lockdown 2020 levels.
It was to be expected that when lockdown came, market activity dropped quite radically. It was very difficult to do property transactions last year in the second quarter. And so we saw big drops in our broker, F&B commercial property broker surveys in industrial, office and retail and hotel property for that matter. Hotel probably the most severely impacted by far, although that's a smaller one of the sectors. But, it was disrupted, it was shut down, there was very little you could do. And so it started coming back reasonably well.
The supply-demand balance for the industrial property sector is showing growth. This is some good news as it is an indication of an uptick in economic activity.
The best of the three big sectors is industrial. It's the most affordable, so I think it's least threatened by affordability constraints. And, warehousing space is highly adaptable as well. You can use, I've even heard of people using it for sort of makeshift offices. You can use warehouse space for a lot of things in financially tough times. But there's the increased interest in logistics because of the e-commerce drive to get new depots nearer to your end consumer and so on.
The growth outlook, though, will most certainly be adjusted considering the mayhem in South Africa currently. There's been widespread looting in two major provinces of the country, affecting warehousing, factories, storage and logistics.
Nothing's really very strong at the moment in a recessionary environment or an economy struggling to emerge from recession. Manufacturing took a big knock last year, and I'd say the manufacturing part of property, of industrial property, did less well last year.
The ongoing looting and destruction of property is a massive setback for South Africa. All efforts were being concentrated on vaccinations and reviving this weak economy. In most areas, building and construction has either slowed or stopped. Investments may also be put on hold or withdrawn. It's a real blow to efforts in getting this economy back on track. Sumitra Naidu, CGTN, Johannesburg, South Africa.
Well, let's head to Egypt now, where the country's central bank has announced that external debt jumped 21% in the third quarter of the 2020-2021 fiscal year. This is as total external debt rose to $135 billion from $111 billion recorded in the same period the previous year. Well, as CGTN's Yasser Hakim now reports, a decline in forex inflows amid rising expenditure to curb the pandemic have led to soaring debt.
Egypt's external debt is piling up. It has increased extensively since 2016, as the government allocated funds for extensive economic reforms and a rebuilding process after years of political instability following the 2011 uprising, and has risen even further due to the outbreak of the COVID-19 pandemic. Egypt's government was forced to tap the debt market again in 2020 to cover the losses incurred by the pandemic-induced slowdown, which led to a 21% jump in loans the last year.
Of course, this is a very high number, but it's still in the safe zone for debt. It is calculated through the ability to repay, the growth rates and payment facilities. So far, all are good and positive. The loans are 37% of GDP, which is still a safe zone. These are two sources of the debt, the loans and bonds. In the last quarter, loans were $50 billion and bonds totaled $25 billion.
To bridge the gap without putting a burden on the state budget, the government has been reverting to long-term loans with maturities of up to 20 and 30 years. But it's not all gloom for Egypt's forex inflows. The country's main source of hard currency, such as remittances from expatriates and revenue from the Suez Canal, have been on the rise. However, more effort is being done to support ailing resources, such as exports, foreign direct investments, and tourism, which have been battered by the pandemic.
There are several initiatives being made in Egypt to attract investments with new regulations and facilities. Also to attract tourists, we've seen the government opening up new museums, the return of tourists from East Europe and especially Russia, which is an important market, and improvement in infrastructure. The country is seeking to receive more tourists from Russia, who at one time reached 3.5 million and earned the state about $4 billion in revenue.
The finance minister has not ruled out another plunge in the debt market, but has stated this move will be less frequent moving forward. The strategy, authorities say, is to reduce total debt from 90% of GDP to 70% of GDP by the 2024-2025 fiscal year. Yasser Hakim for CGTN, Cairo.
Well, let's turn our attention to some of our corporate headlines today. South Africa's Standard Bank is set to acquire the remaining shares in Liberty Holdings that it doesn't already own. Africa's largest bank by assets is seeking to integrate the insurer and asset manager as it eyes the creation of a diversified financial services group in Africa. Now, the share price is set at $6.76, representing a premium of 32.8% in Liberty's share price, with the company valued at more than $1.7 billion. Meanwhile, Safaricom's plan to expand to Ethiopia has been complicated by a U.S. state financier threatening to recall its loans, and that's following an escalation of an armed conflict in the country. The U.S. International Development Finance Corporation says the acts of violence against civilians in Ethiopia's Tigray region could affect the release of a $500 million loan to a consortium led by Safaricom. Now, the deepening conflict in Ethiopia could force this DFC to pause the investment and push the telecom firms to source the cash elsewhere and at a greater cost. Meanwhile, the owner of John Lewis and Waitrose is planning to cut 1,000 jobs in stores as part of an effort to cut its costs. The John Lewis partnership adds that it aims to find new jobs for those losing their store management roles, and it'll also try to reduce compulsory job cuts by offering voluntary redundancy to those affected. The move follows the closure of 8 John Lewis shops earlier this year, which put almost 1,500 jobs at risk. And finally, Johnson & Johnson is voluntarily recalling 5 Neutrogena and Aveeno brand aerosol sunscreen products. That's after detecting a cancer-causing chemical in some samples. The company says that consumers should stop using the products and discard them after internal testing identified low levels of benzene in some of its samples. Well, J&J is also notifying distributors and retailers to stop selling the products and arranging for their return out of an abundance of caution. And that's a look at our corporate headlines. Well, we are heading into a short break now, still coming up on the show. Zimbabwe's state-run rail company plunges into $1.6 billion in losses in the first half of the year. And COVID-19 disruptions push millions of Nigerians into hunger.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business, only on CGTN.
Africa is the nexus of enterprise, and global business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues from taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Welcome back. Now, audit and consultancy firm Deloitte expects East African economic activity to pick up in 2021, growing 3% in comparison to 0.9% in 2020. Now, in its update on the economic impact of the COVID-19 pandemic in the region, Deloitte says growth will mainly be driven by private consumption and domestic demand. The outlook also projects recovery to be accelerated by tourism, agriculture, and manufacturing sectors, which were greatly hit by the pandemic. Now, the region is estimated to have lost $4.8 billion in international tourism receipts in 2020, owing to a ban on international travel and national lockdowns across the globe. That, of course, subsequently resulted in the loss of about 2 million jobs. Well, let's now delve further into this with Deloitte. We're joined by Tewodros Sise. He's the Associate Director at Deloitte's Financial Advisory here in East Africa. Great to have you with us, Tewodros. Now, of course, according to your report, you expect the region to bounce back, grow by 3% this year. Given that the virus threat is far from over on the continent, may even be getting worse, still pretty uncertain, what are the factors that you think will keep economies in the region resilient?
Thank you. Good evening, and thanks for having me as well. So if you remember from last year's publication, we were very pessimistic about the different sectors impacting the economy. However, contrary to what we were expecting, the agriculture sector really helped the economy to bounce back by 0.9% and really helped the East African economies to avoid recession. So in 2021, we expect sectoral growth, more specifically in agriculture. If you have seen, the global commodity prices have been increasing, so that would really help economies that are relying on coffee, tea, and horticulture. And we expect growth in manufacturing, transport, and construction because of the infrastructure investments in countries like Rwanda, Ethiopia, and the mining sector in Tanzania as well to pick up. So those will really support the economy to pick up in 2021. And hence, that's where our expectation for 3% growth is coming from.
Now, some may say that's quite optimistic because let's look at the realities on the ground right now. We're seeing the possibility of the recurrence of lockdowns, especially looking at the somewhat slow rollouts of vaccines across the region. What are the chances these factors could hamper or be an obstacle to a that pickup in economic activity that you see?
Absolutely. I mean, I agree with them. The past 2 years really showed us, doing economic forecast is the most difficult thing. So we really also expect if these issues that you just mentioned, the additional issues that I'm going to mention, is going to come back, and it's going to bite back the countries as well. For example, now most of the countries are really fighting inflation because of the depreciating currency. You can see that in Kenya. In Ethiopia, the two biggest economies in East Africa. So inflationary pressure is going to be one of the toughest things for central banks to manage. And you'll see increased debt levels as well. So now it's really eating into the fiscal or the budgetary issues that countries are facing now because of the support that they were providing through tax cuts as well as sectoral supports. And then, of course, the recurrence of lockdowns as well. I mean, we have seen Uganda going back into a 42 days lockdown. So all these things are, all our forecast is contingent on these matters. If this is going to come back, of course, economies are going to really impacted by the negative impact of these variables.
Now, of course, as you just mentioned, your report also assessed the measures taken by respective governments. In light of this, what's your perspective on the extent of budgetary pressure on some of these economies, and of course, how that could impact the outlook going forward?
Yeah. So I mean, the biggest challenge that we see for the region is, of course, debt management. If you look at the debt to GDP ratio have really increased to 66% in 2020. We expect this to go to around 75% in 2021 because the countries really need to finance some of the infrastructure investments they have because some of the countries are really reliant on infrastructure growth. And all of the countries are really dependent on agriculture. So they really need to support all these things. So that means now they need to have, they are going to have gaps in their budgets and they need to finance that gap. So all that is going to now impact all the payments that goes through that for the dates, for all the dates that they are taking and they will take in the coming few months. So we really think that is one of the key things that's going to impact East African economics. I think if you look at it, the tax cuts and all sectoral supports had to be financed through debt. And if you have seen some of the new tax implications, for example, now the full tax payments that are coming back is really going to impact the economy. But for me, the most important thing is the debt management. So prudent management of that debt is going to be very critical for these economies.
Well, we do have to leave it there, Tewodros. Thank you so much for your insights. That, of course, is Tewodros Sise, Associate Director at Deloitte East Africa. And moving on now, the Central Bank of Nigeria has released regulatory guidelines and a framework for mobile money services in the country. The Apex Bank says its target is to regulate the growing sector as well as increase the level of financial inclusion across the West African nation. Here's our correspondent Fili Ihaza with more from Abuja.
This is a mobile money kiosk on the outskirts of Abuja, and the owner, Walter Obuanyi, receives his customer's bank card to help him withdraw some cash. Walter says he makes good profit daily from attending to customers because there are no physical banks nearby.
Going to POS business, and so far since 2017, it has been a profitable business. At first, people were afraid to use it, but now people prefer to come to my outlets instead of going to bank because it's closer to them. So far, it has been wonderful.
Mobile money services was launched in Nigeria in 2009 to help users access their money without going into a bank. Also to help people make transactions using a wallet that is connected to their mobile phones. But till now, only about 15 million out of over 200 million Nigerians subscribe to the service, according to a report by Access to Financial Services in Nigeria. In order to make the service more attractive to users, the Central Bank of Nigeria has introduced a framework to manage and regulate the operations of mobile money agents. It says this will prevent fraud, exploitation, and provide better access to credit for both the users and service providers.
So the framework is actually advantageous to them in the sense that it also provides protection for them. Their roles and responsibilities have also been defined very clearly. And for the consumers, in the past, when somebody has no problem with their mobile money transfer, the telcos will tell you they are not the banks, right? But these days, the CBN framework now made it a bank-led thing. So it means that you can tie your mobile wallet to a bank. And so if there's an issue, the bank will be able to address that problem for you.
The Apex Bank set a target of hitting 80% financial inclusion by the year 2020, but has only been able to hit about 63% so far.
The move by the CBN to improve mobile money services in Nigeria could help the country move closer in achieving its target of financial inclusion for a majority of Nigerians, ease transactions among them, and boost the nation's economy.
But experts say the government will need to create a more enabling environment for the business to thrive before the country can fully achieve a cashless society.
There needs to be a lot of advocacy to these rural areas. That is currently ongoing, but the state of the country in terms of security is affecting that at the moment, which is part of the enabling environment we want to see for this mobile financial inclusion service to get to some parts of the country. Because we need these agents to hit very distant communities and enlighten them on the benefit of the services, for them to see the need to move their monies from their pots and under their bed into a mobile wallet where it can be captured in our financial system.
President Muhammadu Buhari has promised to end kidnappings and terrorism in parts of Nigeria so that entrepreneurs like Walter can operate better even in more remote parts of the country. Phil Ihaza, CGTN, Abuja.
Now, the National Railways of Zimbabwe says it has lost more than $1.6 billion during the first 6 months of 2021, and that's due, of course, to the COVID-19 pandemic. Now, according to the company's board chairman, the state-run railway lost about $516 million in potential revenue during the first quarter, while the second quarter saw losses exceeding $1 billion. Here's CGTN's Farai Mwakutuya with the details from Harare.
The state-owned rail company, which provides bulk freight services to key sectors including energy, mining and agriculture, says a slowdown in global markets due to declining mineral prices as well as delays in approving investment projects and the redirecting of resources to healthcare instead of fuel and grain imports have reduced demand for its services and resulted in the loss of business which it had anticipated for 2021. A company statement said $516.4 million in potential revenue losses had been recorded during the first quarter of the year, while over $1.143 billion had been lost during the second quarter. The losses extend a COVID-19-induced slump which began in 2020 when the company moved 2.5 million tons of cargo, down from 2.8 million tons the previous year. They also compound long-running viability challenges for the ailing state-owned enterprise, which has failed to attract investors to upgrade a dilapidated rail network and purchase new locomotives and wagons. Farai Mwakutuya, CGTN, Harare, Zimbabwe.
Now, of course, the COVID-19 pandemic disrupted the global workforce, resulting in millions of job losses. Well, in Nigeria, the situation is deemed quite dire. Millions of Nigerians who were once on a solid financial footing in Africa's most populous nation and largest economy are now struggling to feed themselves and their families. Here's CGTN's Penina Karibe reporting.
In Africa's most populous country, employment opportunities have dwindled. More than 3 in every 10 Nigerians who were working before the outbreak of coronavirus in the country are jobless. Desmond Okorie is among those affected by the harsh impact of the global outbreak. Before the pandemic, Desmond traded as a machinist for a local furniture store in Lagos for over a decade. Now, the father of 5 picks used cans for recycling and also works as a contract-based bricklayer to feed his family and pay the bills.
In a day, we can gather up to 30 kilos. So when we gather it, then we give it to them. They will now measure it and give us the money. This is where we cook. Something like this bowl is where we keep something like gari. As you can see, nothing is there.
Okorie's weekly income is $20. He says he is unable to cater for his family's weekly expenditure of $40. Since COVID-19 hit Nigeria, prices for some basic goods such as eggs, onions and palm oil have risen by more than 30%. Okorie now relies on donated food and sometimes keeps meals to feed his family.
The way we are living is very, very hard. But honestly, it's a kind of hand to mouth. Before this time, things was very easy. Types of buying foodstuff. We buy a derica of beans, 100 naira. Then Vietnam is 500 naira.
Millions of Nigerians who were once on solid financial footing can no longer reliably feed themselves or their families. According to the World Bank, roughly 18% of households in Nigeria have at least one adult who does not eat for an entire day at a time, compared to 6% before the pandemic.
People who ordinarily would not even imagine queuing up for food, right, are now in that category of people that we serve. And some would even say that, you know what, I don't care, I just need to feed my family. So at this time, we've seen an increase in in the number of people we serve, and in fact more than 40% increase.
Cost increases have affected the food bank too. A 100-kilogram bag of beans that cost $73 before COVID-19 hit now costs $160. This has forced the bank to cut the amount of food in each pack. The World Bank estimates that price shocks in 2020 have pushed 7 million additional Nigerians into poverty, an increase of nearly 10%. For Okorie, he hopes the government can tackle this seemingly never-ending nightmare. Penina Karibe, CGTN.
And marking World Youth Skills Day, analysts in Ghana want young people to take up a technical and vocational training in order to obtain skills for craftsmanship, which of course could help them reduce the unemployment rate in the country. CGTN's Nabil Ahmed Rufai with more from Accra.
Philemon Doji is learning how to make a food processing machine at this engineering workshop. He relocated from his village in the Volta region in eastern Ghana to acquire skills in this trade in Accra.
My chances of getting employed were limited after I completed high school, so I realized I needed some vocational skills to get a job.
Like Doji, many of the young people here dropped out of school at an early age due to poverty. They say the work they do here is their only way to earn a living. The ability to cut metals into pieces and later join them are key skills needed during the manufacturing process. It may seem easy, but it requires a lot of technique. It takes 4 years for Christopher Dono to train people on how to manufacture machines and other equipment.
If I see these young guys going up and down without doing anything, they pay me. So I decided, I called their parents, if you have a child, we want to learn, do it to me.
Analysts say technical and vocational skills development can help reduce unemployment among young people, but there is a need to make it attractive.
If we focus a lot of attention on technical vocational education, the skill set we'll have in this country, and in Africa for that matter, will be great enough to be able to reduce unemployment.
The government says it wants to bridge the gap in skills development in the country.
We have developed a very comprehensive industry-responsive skill-based activity and the soft skill-based activities that we will be doing to mop up these people in the system. And then once they do that, the good news is that we are prepared to set them up. And the only precondition is that you must be prepared to be set up in areas where you can affect a lot more young people so that we achieve that multiplier effect.
Still, analysts want the government to create incentives for young people engaged in skills development. In the meantime, Philemon Doji wants to learn more about this craftsmanship as he sharpens his skills with hopes of setting up his own business one day. Nabil Ahmed Rufai, CGTN, Accra, Ghana.
And moving on now, agriculture stakeholders in Africa are urging governments on the continent to work with the private sector to build resilient food systems in order to bridge the widening gap in production. Now, they say Africa's agricultural transformation is reversing gains made and progress is being weighed down by increased pressure on resources, exploitive market dynamics, extreme climate, and more recently, COVID-19. They also say conventional approaches to agriculture on the continent have not been entirely effective so far. Well, let's discuss this further with Dr. Tilahun Amidi. He's the head of Resilience, Climate and Soil Fertility at the Alliance for a Green Revolution in Africa. Great to have you with us on today's show, Dr. Tilahun. Now, of course, let's start by giving us some insight as to why AGRA thinks that models of agriculture, for example, such as agroecology, which of course models itself on traditional farming methods, why have these models not been so effective in helping to boost and protect Africa's smallholder farmers, and of course in helping Africa's agriculture transformation?
Yeah, good evening. Thank you for having me. You know, the concept of agroecology emerged in Europe, where have a very intensive crop and livestock production, where there's excess application of fertilizers, pesticides. Livestock is fed by grain. So really intensive systems which are hurting the environment. Contaminating water, you know, killing the bees in the environment. So, you know, they could go fully organic because there's a huge nutrient pool in the soil. So they can, without intensive application of fertilizers and other things, they can still produce reasonable amount of yield, up to 2050, without yield loss, in fact. We in Africa, you know, we are almost growing organic for centuries. And, you know, our systems are mined. We have a very low production and very low biomass. So even if we want to go to, you know, agroecology-based, organic-based systems, we cannot. Because the amount of biomass that is, you know, that can be recycled in the system is so tiny that, you know, if you have a hectare of land, you can only fertilize about 10 to 15% of your land with available biomass. And above all that, we have, you know, a strong competition for biomass because, you know, we rely hugely on, you know, biomass, on, you know, trees for energy, for cooking, for house making. There's a lot of competition. So our systems cannot sustain the required, you know, food demand and the increasing population with the existing, what you call agroecology based. So what we are doing in AGRA is trying to hybridize the, you know, the agroecology concept with the sustainable intensification concept, whereby, you know, some of these systems are supplemented by external inputs like fertilizers.
Right.
So
and I just want to get into that. Sorry to interrupt you, Dr. Tilahun, because AGRA is advocating for what you call a sustainable farming model, which basically integrates a number of factors. So my question to you is why you believe this model could be the answer to boosting agriculture effectively going forward?
You know, the existing models in Europe, in North America, are targeting mainly, you know, production, productivity. But in Africa, you know, because of climate change, because of land degradation, but also because of low productivity, we have multiple objectives, you know, so the existing systems are not really addressing these multiple objectives and livelihoods of options of farmers. So what we're trying to do is bringing, you know, the best practice from all over the world, from Green Revolution in Africa, I mean, in Asia, in Latin America, the organic farming systems in Latin America, and then hybridize with our own, because we have peculiar problems in the continent. One is unlike many other, continents, that we have an increasing population. So our farm size is getting smaller and smaller, but also, we are energy poor. So most of our systems are relying on biomass again for cooking, for charcoal making. So, we are deforesting our systems, we are degrading our systems. So all this really needs an African-based homegrown solution. And that is what AGRA is trying to do, trying to bring the different best practices together and advocate for integrated solutions through sustainable farming models.
And you say it integrates local food systems, profitability, use of resources, renewable energy. Tell us how.
Yeah, African countries and systems are very diverse. So we have about 13 distinct farming systems in the continent, which have peculiar characteristics, peculiar needs, but also we are at different levels of intensification. So some countries, like in the Sahel, you need water. In Congo, you need probably soil fertility management. In the remote highlands of Ethiopia, you need markets. So we have different entry points to facilitate system change in the continent. So we cannot adapt what we have in these industrialized, large-scale farming systems in Africa because of this diversity, because of the degradation we have, the poverty level we have, and also very limited mechanization. We largely are one-ton agriculture. So we really need, a combination of technologies and best practices to work for Africa. And that's really what AGRA trying to achieve, supporting countries, supporting, the continent by developing context-specific solutions.
Right.
And that's where really this concept of sustainable farming comes in play, really to bring productivity, profitability, and resilience of systems.
Certainly an interesting and extensive topic, but we have run out of time, Dr. Tilahun. Thank you so much for your insights today. That, of course, was Dr. Tilahun Amede. He's the head of Resilience, Climate and Soil Fertility at the Alliance for a Green Revolution. Well, on that note, let's take a short break now. Still to come. U.S. Federal Reserve survey shows the economy strengthened further in late May and early June. And data security becomes a heated topic in China after the country's internet regulator warns tech giants against leaking user information.
Taken me completely out of my depth, but at the same time it's exciting. It's new, it's different, it's a challenge.
It's really exciting.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant.
Only on CGTN.
And here's a quick recap of today's top headlines. After days of violent riots and looting in South Africa, the death toll has risen to 117. Now, volunteers have begun cleaning initiatives in some of the worst affected areas of Johannesburg and Durban. Several neighborhoods remain quiet on Thursday as people dotted the streets to clear up rubbish. And this comes after South Africa's defense minister announced the deployment of 25,000 soldiers in KwaZulu-Natal and Gauteng provinces. Now, the initial riots were sparked by the jailing of ex-president Jacob Zuma last week. And Tunisia's health ministry says the country's healthcare system is collapsing amid rising cases of COVID-19. Hospitals in the North African nation have seen a significant influx of patients over the past 2 weeks. The current wave has prompted President Kais Saied to appeal for international support in dealing with the situation. So far, only 750,000 people in Tunisia have been fully vaccinated out of a total of 11.6 million residents. And in Uganda, campaigners are pushing the government to regulate the cost of COVID-19 treatments in private health facilities. They are concerned that the fees being charged are denying patients the required treatment. Now, although the courts last week ruled that the health minister and the attorney general must intervene on the cost of COVID-19 treatments, the realization might take a while. And that's a recap of top headlines. And to some international news now. The world economy is slowly starting to recover from COVID-19, though in an uneven way. China is no different, as the country's recovery is also showing signs of an unbalanced recovery. Well, CGTN's Liu Shixian has the latest details on the economy from a State Council Information Office news conference held in Beijing on Thursday.
China's GDP grew at 12.7% year-on-year in the first half of 2021, down 5.6 percentage points from the first quarter. At the same time, growth for China's consumer price index, the main gauge of inflation in the first half of the year, was 3.3 percentage points lower than the same period last year. A spokesperson for the National Bureau of Statistics says falling food prices are the main reason for the decline.
In
the first half of this year, food prices dropped 0.2% year-on-year, compared with a 16.2% rise in the same period last year. Food prices, once the main driver of higher consumer prices, are now the main cause of lower consumer prices.
Data also shows the unemployment rate for urban youth aged 16 to 24 was about 15% in June, up 1.6 percentage points from the previous month. The spokesperson says structural problems in employment are becoming more pronounced.
It is true that the scale of college graduates this year reached 9.09 million, a record high. The total employment pressure is indeed relatively large.
In general, China's animal husbandry and high-tech manufacturing sectors also rapid growth in the first half of the year. However, the growth rate of the household income was slightly lower than the economic growth rate. Liu Jiaxing, CGTN, Beijing.
And in the U.S., the Federal Reserve's latest nationwide business survey found that the economy strengthened further in late May and early June. That's despite supply chain bottlenecks that led to price hikes. The report released on Wednesday shows that some of the fastest growth was seen in sectors hard hit by the pandemic, such as travel, tourism, transportation, manufacturing, and non-financial services. Prices rose at an above-average pace, with 7 of 12 Federal Reserve districts reporting a strong price growth. The report, however, cited widespread supply-side disruptions, such as shortages of goods, low inventories, and delivery delays. Now, the U.S. economy is rebounding strongly from the recession brought on by the coronavirus pandemic. Now, next is the message on inflation from the head of the U.S. Central Bank. Consumer prices witnessed their biggest annual surge for more than a decade. But for now, investors seem to have confidence in the Federal Reserve's ability to keep inflation on a target. Here's Owen Fairclough reporting.
There are signs of it everywhere. From airfares to used cars. Consumer prices have surged 5.4% over the past year. the sharpest rise since 2008, the year of the last great economic crisis before COVID-19. You could be forgiven for thinking that inflation was a thing of the past. Despite interest rates being ultra low for more than a decade now, inflation has also stayed low. But the US arguably has too much of a good thing right now, an economy that's roaring back to life after it was shattered by COVID-19, and in some cases, inflation being driven by a classic case of demand outstripping supply. The US Federal Reserve's aim is to keep inflation at around 2%, a figure considered optimum for sustainable growth. But its head, Jerome Powell, told lawmakers that once you strip out these price surges for industries witnessing pent-up demand, inflation won't be a problem.
With inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%.
Investors seem to preempt that sentiment. The S&P 500 stock market hit yet another record high just hours before Powell spoke, as some of the world's biggest companies announced impressive earnings.
People are expecting gains for the S&P in earnings of over 50% this quarter, so investors are expecting a pretty good season.
But if the economy is on course to reach full employment again, the Fed is concerned that some people laid off in the pandemic have effectively given up looking for work. One reason it plans to maintain interest rates at their current lows for both employers and consumers. Owen Fairclough, CGTN, Washington.
Now, data security became a heated topic in China after the country's internet regulator warned tech giants against leaking user information. Well, Zhu Zhishan has more from this year's China Internet Conference, where the issue is dividing participants.
When asking participants at the 20th China Internet Conference if they worry about their private information being leaked online, some shrugged off the concerns, while others answered with an emphatic yes.
I think some of the internet companies acquiring personal information have gone too far. Once your real name, ID number, and home address is given, your privacy won't be protected. I'll often receive text messages from other platforms, which means your information has been stolen or leaked.
Ride-hailing companies can store where I live, work, and often go to. It would be terrible if private information like this was leaked.
The concerns are also shared by professionals.
Data flow in particular has exposed growing problems. So when we're strengthening the big data industry, security management and control is very crucial.
China's big data market exceeded $10 billion for the first time in 2020 and is expected to surpass $20 billion by 2024. And the risks are now embedded in this intelligence-driven world.
Through big data, our daily life, industrial production, military, transportation, and even our national security can be at risk.
China's Cybersecurity Authority on Saturday said any Chinese company with data of more than 1 million users should request a security review before listing its shares overseas. The announcement comes after its probe into ride-hailing giant Didi that it says illegally collect user information.
Chinese government's relaxed policy has fostered continuous growth in the country's internet industry and some leading global businesses. For enterprises, they should not only shoulder the risk of technological innovation, but also policies. Many of them are legally cautious about big data usage. Now the regulations and probe could also guarantee their cybersecurity practices.
A protection system requires the collection, transport, storage, processing, sharing, and destruction of data. Given Beijing's stronger emphasis on data security, experts say there are more market opportunities for internet firms to engage in China's law-based cybersecurity governance. Zhou Jiaxing, CGTN, Beijing.
And moving on, let's take a look at commodity markets today. Oil prices falling today above 1%, extending losses as investors brace for increased supplies. That's after a compromise deal between leading OPEC producers today. Also, U.S. fuel stocks rose, raising concerns over demand in the world's largest consumer. Meanwhile, gold prices slipping just below a 4-week high, which was hit in the previous session. That is as the dollar clawed up in Asia trade after falling the day before. Now, the U.S. Fed Chair Jeremy Powell has signaled powerful support for economic recovery, which certainly helped the dollar today. And moving on now, let's head to Tanzania, where the government is waiving a value-added tax on smartphones, tablets and modems. The move is part of a plan to bring internet penetration in the country to 80% by 2025. That's from the current 46%, as CGTN's Isaac Lucando explores, now from Dar es Salaam.
Basically, when you come here, and
smartphones could soon be within reach for many ordinary Tanzanians. While statistics show that at least 78% of households own a mobile phone, most are not smart devices.
The telecommunications sector has been growing well to become a key component in expanding financial inclusion for citizens who live in a digital world. I, therefore, propose to waive value-added tax on all smartphones.
On average, a simple smartphone costs around $30, which puts them out of reach for many Tanzanians. With value-added tax waived, smartphone traders like Tony Albert say they could see a boost in sales.
People want smartphones that are fast, have ample storage space and a good camera. They want to be able to connect with people on social media. They want to push their products or push their content, so that's why the demand for smartphones is high.
According to the communications regulator, Tanzania has around 44 million mobile subscribers, but only slightly over half get internet. 2/3 of those locked out of internet access live in rural areas.
But at close to 50% internet penetration, Tanzania appears to have made strides compared to parts of the continent. The average internet penetration in Africa is around 29%.
While the move to waive value-added tax on smartphones has been largely welcomed, this economist warns that the government's recent increase in taxes on internet bundles could scale back any gains made.
The increment in cost of bundles can impede actually the initiative of removing the VAT and allowing more people to have access to these gadgets. But if you compare to our peer countries, meaning the neighbors, Tanzania has the cheapest internet. If you look at within the East African community. So my hope is that even with these increments, we are still very cheap compared to all of them.
The government hopes that more smartphones in the country will make getting information and doing business in a digital world much easier. It hopes to place access to the world in the palms of its citizens. Isaac Lucando, CGTN, Dar es Salaam.
And before we leave you today, here's a quick look at Africa's currencies. South Africa's rand rising 0.4%, outpacing its peers in the Europe, Middle East and Africa region. That's as it extended a recovery into a second straight session. Of course, fears of escalating violence in the country had brought the rand to a 3-month low yesterday. Meanwhile, the Kenya shilling continuing to come under pressure as demand for dollars increased in the market. Nigeria's naira remaining unchanged today on the black market at a more than 3.5-year low of 505 naira per dollar, which of course it hit last week. And that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on your screen. You can also follow us on our various digital media platforms. From me, Uche Okoronkwo, and the rest of the team, thanks for watching.